I'm just going to get right into it then here. This is a what you need to know presentation for first-time home buyers. We're going to touch up on a lot of topics, and if there's any questions at the end, if you have any questions as we go through, just write them down and you could ask them at the end. We'll get right on into it here. So affordable housing is a household that you can pay for and still have money left over for other necessities like utilities, food, transportation, and healthcare. And it really depends ultimately on a household's income. And lenders will determine affordability using certain metrics such as a debt to income ratio to calculate the amount of money that you can borrow by comparing your total monthly debt to your total monthly gross income or pre-tax income. So it's ultimately up to you, the home buyer, to decide what is affordable. But there are, other factors that play into this calculation that we will discuss later. And some important factors that, we should consider when determining what is affordable for you is to determine first your household budget. It's important to factor in your monthly income in all monthly expenses. So we're going to cover how to calculate your debt to income ratio more in detail a little later, but know that lenders will calculate your debt to income ratio for qualifying purposes. So as a home buyer, you'll want to have a certain level of comfort and understanding that your monthly mortgage payments, and if a lender pre-approves you for a certain loan amount, that monthly payment amount may not fit into your overall household budget without getting rid of some other expenses elsewhere, even though you are technically qualified for that amount. So a good rule of thumb is to have some reserves. So have at least 3 months of payments for your bills, including, your household payments and other monthly debts as well. And this will allow you to cover your mortgage payment in case there's an unexpected event that comes up in your life. And something that lenders will do is look at your credit too, and in qualifying. So lenders will use your credit score to determine your credit worthiness, and if you qualify, it also determines what type of interest rate you can get. The better the credit score, the better the rate, typically. So the credit bureaus submit their data through the FICO algorithm, and it produces a score. So your FICO is your credit score, and some might be asking, what are the credit bureaus? Well, there's three of them with mortgages. It's Experian, Equifax, and TransUnion, and each have their own score. And your credit score for your mortgage is your median score. So if you got your three scores, the one that's in between. So you could have a six, let's just use an example, 650, 670, and 665. The middle one would be the 665. So that would be your score. Now, how could you ensure that you have good credit? Well, first, check your credit score. You could obtain free copies once a year. You could also use Credit Karma, but that's less reliable in terms of accuracy, as it can show your score as being lower than your actual score. Ensure that you're working towards paying anything derogatory off or anything that's in collections. Medical collections have less of an impact, so you don't need to worry about those as much, but check your credit report for any discrepancies or errors that need to be corrected. And you do not need to pay for a rescore once these corrections are made. And also, make sure you're paying your bills on time, of course, and keeping your balances low. That's just good rule of thumb. Now, start saving early. It's never too late, and no amount that you're saving is too little to save. Just start working towards saving. So before you start looking for a home, you want to save for down payment and closing costs. So closing costs are not included in your down payment. They're two separate expenses there. So the down payment is the amount that you'll need to save and depend how much you'd like to spend on a home. And most down payments range from 3% to 5% of your total loan amount, depending on the program you use. And you could put down, of course, if you put down 20%, then you'll be eliminating the PMI. We'll get in a little bit more into that later. The closing costs include taxes, insurance, recording fees, transfer tax fees, title fees, appraisal fees, and much more. You can um, also for homeowners insurance, and you should anticipate your closing costs to be around 2 to 5% of your total loan amount. Um, Also know that there are some down payment assistance programs that are available. There are many down payment assistance programs from lender to lender, and that could help mitigate those closing costs. So you want to talk to a mortgage professional and see what programs that they could qualify you for. Just a little bit about wholesale, wholesale versus retail. So there's really primarily two different types of lenders that you could work with. You have your wholesale lenders and your retail lenders. Retail lenders handle everything in-house, but they could only offer their in-house products regardless of the needs of their clients. So wholesale mortgage brokers have access to multiple lenders and those lenders' respective loan products. So brokers like myself work with borrowers to get their mortgage through the wholesale lender. Wholesale lenders are responsible for underwriting and funding the loan, while retail loans again are handled in-house. The lender works directly with the borrower, and they are only able to offer products from their own institution. So you can just a little bit of an analogy. You could think of getting a mortgage the same way, you shop for a pair of shoes. If you want a new pair of shoes and walk into Nike, that's like going to a retail lender. The salesperson will ask you what you need the shoes for, what style you're looking for, what your budget is. But when they recommend a shoe, it'll be from their brand only. They'll only recommend you Nikes because you're in the Nike store. Now, if you go to a local shoe shop that's an independent store that carries multiple brands, they'll ask you those same questions and then recommend the shoe that fits your needs best. So they'll have multiple brands to suggest versus just one single brand. So that's kind of a good way of thinking of retail versus wholesale. Working with a loan officer. So as a broker, we'll discuss the different loan products available to help you decide what kind of loan is best for you. And we'll discuss the different types of loans later on in the presentation too. But we'll also calculate again the amount of money that you can get a loan for, which ultimately determines how much you can spend on a home by determining your debt to income ratio. Before you shop, just a little bit about the process. So after you have determined what you can reasonably afford for the monthly payment and the down payment and closing costs, the next thing you'll want to do is hop into the pre-approval process. So as a borrower, it's important to know what a mortgage pre-approval does and doesn't do, and how to boost your chances of getting one. Um, Once you've determined your lender and get a pre-approval, we're going to talk about, why you want a pre-approval and the difference between a pre-approval and a pre-qualification. We'll also talk about the information you'll need to gather, putting together your numbers and reviewing your options. You've probably heard the term pre-qualification used the same way as the term pre-approval, but they are not the same. With a pre-qualification, you state an overview of your finances, income, and debts to a mortgage lender. That mortgage lender then gives you an estimated loan amount. So a pre-qualification can be useful as an estimate of how much you could afford to spend on a home. However, the lender doesn't pull your credit or verify your financial information, which means pre-qualification is a helpful starting point to determine what you can afford, but really has no weight when you want to make offers. It's the takeaway here is that with a pre-qualification, none of the information provided is verified at that point in the process. Because none of the information is verified, there are also no guarantees that you will receive a final approval for that pre-qualified loan amount. Now, a pre-approval, on the other hand, is a lender's offer to loan you under specific terms, such as the loan amount and interest rate. You'll want to apply for a pre-approval when you're ready to start shopping for a home. It shows sellers and agents that you are serious, and it gives you an advantage over other buyers without a pre-approval, although most other buyers should have a pre-approval or else they're not going to get their offers accepted. So a pre-approval involves filling out a mortgage application and providing your social security number so a lender can do a credit check. During this process, a lender pulls your credit report and gets your credit score to assess your borrowing history or financial character before deciding to lend you money. Now, also, during pre-approval, you'll list all of your bank account information that you need to that are tied to assets that you need for your down payment, any debts, income, employment history, past addresses, and other critical details for a lender to verify. The reason for this is a lender is assessing if you can pay back the loan. Mortgage pre-approval letters are typically valid for a limited number of days, I think about 90 days. And lenders put an expiration date on these letters because your finances and credit profile could change, from that time period. So if a pre-approval expires, you'll have to fill out a new mortgage application and submit updated paperwork to get another one. And it's important to remember that while you are filling out an application and getting credit pulled for a pre-approval, it still does not guarantee a final approval for the loan. Now, in order to get your pre-approval, you'll need to put together some documents to verify the information. The more organized and prepared you are for this process, the smoother experience you'll have. So you won't be scrambling around looking for all these documents. And these documents include 30 days of pay stubs, W-2 forms from the previous 1 to 2 years. Just get 2 years if you can, just to be safe. Income tax returns and bank statements. And for self-employed borrowers, you'll have additional income documentation to provide. So business tax returns, including all schedules, specifically the K-1, is important for ownership percentage in a business, and profit and loss statements to show the stability of the business income being used. Now, once you have been pre-approved, you want to start looking for affordable houses that meet your personal needs as well as your budget. And this is where a realtor comes in. So you'll want to find a reliable realtor. One of the best ways to find a realtor is through personal recommendation. If you have a friend or a relative who has had a great experience with a realtor, that's a good place to start. Another great way to find a realtor is by checking with your lender or mortgage broker. And as a mortgage professional, we work with realtors all the time. So you can also consider checking online too. Many real estate agents have websites. There's lots of different websites that allow you to search for different agents. For example, realtor.com has a search tool, among some others. Regardless of whether you get a recommendation or a realtor is found online, you'll want to interview them. You need to make sure that you're comfortable asking them questions and that they're available to show you homes at times you're available to see them. So if you could only view homes in the mornings, then you'll need to find a realtor that is available in the mornings, and so on and so forth. Now, once you decide on a realtor, they will often have you sign a real estate contract, and it means that you agree to work with them exclusively. And your realtor isn't paid until you buy your home. So their commission is generally not paid by the buyer, it's paid by the seller through the sale of the home. Now, I want to talk a little bit about making an offer. So your realtor will guide you about making an offer on a home you're interested in. And this is an area where you get to negotiate. There's different types of offers you can make. A full priced offer, meaning you're offering what the house is listed for. And there's a below asking price offer, meaning you're offering less than what the house is listed for. And an over asking price offer, meaning you're offering more than what the house is listed for. Now, you might offer below asking because there was something about the house that makes you and your realtor think the asking price is too high, or you're just unwilling to pay what that asking price is. You might offer over asking price if there are lots of other offers, which is very common in today's market as inventory isn't as high as it's once been, and houses go quick. Now, either way, your realtor will guide you about what offer is competitive and the right choice based on the home. The seller and their agent will then review the purchase agreement and either agree to the terms or they make a counteroffer. And a counteroffer is where the seller can detail if they accept your offer under different terms. For example, you may offer 150,000 for a house, and the seller may issue a counteroffer for 155,000. Now you'll want to work with your realtor in these situations so they can guide you on what the best next steps are. Your offer might not be the only offer, and the seller may choose someone else's offer over yours. So this is where you want to strategize with your realtor. I want to talk a little bit about the earnest money deposit. So an earnest money deposit, or an EMD, is a sum of money that the buyer puts down to show that they're serious about buying the home. So you'll likely put down an EMD if you back out of the purchase for any reason other than the contingencies outlined in the purchase agreement. Then the earnest money deposit that was given may be forfeited. If you back out due to a contingency that was listed, you will have the money returned to you. Now, if you proceed with the purchase, the money is applied towards your down payment and closing costs. So that's money that goes towards the transaction. Okay. Now, I want to talk a little bit about the inspection. Next, you'll need to find an inspector, which your realtor can help you find. This is paid for by you prior to starting the loan process. The inspector will come to the home with you and the realtor there. They will go around the home and indicate if there's anything that needs to be repaired or if there are any concerns such as foundational issues, any issues with the roof, etc. They will then give you a full report after the inspection. And this information can be utilized to help you determine if you still want to move forward. And that is why it is usually a contingency in the purchase agreement. Now, just talking a little bit more about the loan application. We talked a little bit about that for the pre-approval process, but this is what your lender will use to put your story together and determine if you qualify and what documentation you will need to provide. Now, it's important to fill this out accurately with factual information. Now, this is what the application looks like, and this is the information that will be being asked of you. So you're going to be, whoops, skipped ahead there. So things in the application that they're going to be looking for is the type and term of the loan. This will be the loan product you're applying for, the loan amount requested, the amortization period, meaning 15-year loan or 30-year loan, or the number of years you'll be paying the loan over, and the interest rate. Personal information, your identifying information, including full name, date of birth, social security number, marital status, number of dependents, employment history, income and address history, property information, the address and legal description of the property, the year built, whether the loan is for a purchase, a refinance, or a new construction, and the intended type of residency. Is it your primary residence? Is it your secondary residence, or is it an investment property? Asset and liability information is another part of the application. A list of all checking and savings account with your current balances that you're willing to use for the transaction, stocks, bonds, retirement savings, and mutual funds accounts and their values. And then we have the declaration section, and this section shows any judgments, liens, past bankruptcies, or foreclosures, pending lawsuits, or delinquent debts. Now, you'll also be asked to state whether you're a U.S. citizen or a permanent resident, and whether you intend to use the home as your primary residence. The last section of the loan application contains demographic information. For residential mortgage lending, federal law requires that the loan originator ask applicants for their demographic information, ethnicity, sex, and race, in order to ensure compliance with equal credit opportunity fair housing, and home mortgage disclosure laws. Now, applicants are not required to provide this information, but they are encouraged to do so. So the law prohibits discrimination of credit applicants on the basis of this information or on whether you choose to provide it. So applicants may choose as many designations as they would like, or they can choose none at all. However, if you choose not to provide the information, you have made this application in person or face to face, then the federal regulations require the loan originator to note your ethnicity, sex, and race on the basis of visual observation or surname. And the ultimate purpose of collecting this information is to help ensure that all applicants are treated fairly and that the housing needs of the community are being fulfilled. Okay, so let's talk a little bit about equity. Equity is the amount of the home that you own. You have your home value, and your loan amount covers a percentage of that value. Now, your equity is the remaining amount. So the amount that you own. When you are putting a down payment on the house, that down payment is the amount of equity you are going to have to start off. This loan amount is the amount of the home. The loan amount, sorry, is the loan amount is the amount of the home that you do not own yet. It is the amount of the home that is covered by a loan. So, for example, say this house is worth 100K and you put down 10,000. Then you have 10% equity or 10% down. This relates to your loan to value or LTV. Now, there are several different loan programs. So some of them are, but not limited to, conventional FHA and VA. There's also USDA. There are several different loan programs. And so I'll start with the conventional loans. The conventional loans are insured by Fannie Mae and Freddie Mac, and they're federally backed home mortgage companies created by the United States Congress. Neither institution originates or services its own mortgages. Instead, they buy and guarantee mortgages issued by lenders. Now, with conventional loans, typically a borrower will need to have a higher credit score, typically 620 and lower, debt to in 620 and a lower debt to income ratio, usually less than 50%. This is because conventional loans provide a lower down payment option than FHA for first-time home buyers, allowing an LTV up to 97%, which is only 3% down. And mortgage insurance is the money that a borrower pays to a lender that protects the lender against potential foreclosure or default. On conventional loans, mortgage insurance is required when the LTV is 80%. So if you put less than 20% down, then that mortgage insurance is required. And this is paid monthly until you reach the 20% down threshold, where it is reassessed by the company you pay your mortgage to. Now, FHA loans have been helping homeowners since 1934. The Federal Housing Administration, which is part of HUD, the Department of Housing and Urban Development, insures the loan. So your lender can offer you a better deal. The minimum FHA mortgage down payment is 3.5% for those who qualify financially. However, that low down payment option is not available for everyone. These loans are designed to assist borrowers in buying primary residences, and FHA loans are for primary transactions only, and they allow lower credit score, higher debt to income ratio, and potentially a lower down payment. While lenders have similar guidelines for FHA and conventional loans, the requirements aren't always identical. So the most common difference is in the credit score. For example, to qualify for an FHA loan, the borrower needs to have a minimum credit of 580 versus a minimum credit of 620 for a conventional. However, lenders can have their own higher requirements, such as 640, 660, 680, and those are called overlays. Okay, and another difference between the two mortgage insurances is FHA loans require mortgage insurance to be paid for the entire term of the loan. When we were talking about conventional loans, they only require mortgage insurance when your LTV is over 80%. And you could request it off when when your LTV drops below 80%. Okay, now a little bit about VA loans is a VA loan is a mortgage guaranteed by the United States Department of Veteran Affairs. VA loans are available to active duty military members, veterans who have served, and surviving spouses. Okay, and these loans are backed by the federal government but issued through lenders. And most VA loans do not require a down payment. And while the VA doesn't set a required minimum credit score, most lenders will want to see a credit score above 620. Um, and then many lenders could go lower too. But it's important to note that if you do qualify for a VA loan, they cannot be used for vacation or rental properties. Okay, so eligible borrowers can only use a VA loan to purchase a property that is their primary residence or to refinance an existing mortgage. With all that being said, keep in mind the type of loan that you get will come with different requirements and guidelines, and always ask your loan originator which is best for you. Okay, now I want to talk a little bit about interest rates. So there's it's the two most common ways you could package the rate is if you could get a fixed rate or you can get an adjustable rate. Starting with fixed rate mortgages have an interest rate that remains the same for the life of the loan. It's fixed. In other words, your total monthly payment of principal and interest will remain the same over time. Whatever interest rate you choose with your loan originator stays with your loan unless you choose to refinance in the future. Pretty normal, right? So you get a loan and it comes with a rate that you accept. Most people take this route. There is a different route you can take though. That's going with an adjustable rate mortgage. This is a type of mortgage in which the interest rate varies throughout the life of the loan. With an adjustable rate mortgage, the initial rate you choose is fixed for a period of time. After that, the interest rate resets periodically based on market conditions at yearly or even monthly intervals. Now, who would want this, or why would you get it and deal with changing rates? Maybe investors or savvy borrowers. When you go with an ARM, you'll usually get a lower rate up front for a certain duration, but no, it'll eventually go up probably, and then usually a year after, usually year after year. But when the rate is lower, they'll use that extra money to invest and make more. Then when the rate goes up, refinance or sell. Is it guaranteed? No, the rate will always be changing. So we really don't know what will happen. It's a bit of a risk, um, truthfully speaking, but it could work for some people. And there's plenty of different options for those adjustable rates too. You could have it be fixed for the first 2 years, 3 years, 4 years, five, and then so on and so forth. You want to talk to your loan originator about, what might work best for you if that's something you're interested in. Again, fixed rate's the most common and normal way to package it up. I want to talk a little bit about underwriting, okay? Typically underwriting is the longest part of the mortgage process. This is because this is the part where the lender ensures you qualify for the home loan based on your income, debts, and assets. But also they verify the property is okay to lend on. Okay, that's important. This process can go faster when the loan application is filled out correctly up front and the documents are gathered up front. What we talked about earlier also speeds it up, such as not taking out new debt and not making large purchases, being communicating with your loan originator to help ensure the process goes smoothly and quickly. So the appraisal, let's talk a little bit about the appraisal too. An appraisal is a report that a lender requires to determine the value of a home. An appraiser is a licensed individual that will go to the property and determine what the home is worth given the details of the home, such as bedroom and bathroom count, square footage, is there any recent updates, any other features? The current market is also taken into consideration as the value is determined based on what similar homes in the area are selling for. Typically, this process can take 2 weeks to even 30 days, depending on the location of the property and the complexity. The appraisal is necessary to determine if the purchase price is supported and to help the lender determine the max loan amount you can get. The appraisal impacts your loan to value that we discussed earlier. Remember that the loan to value is calculated based on your loan amount divided by the lesser of the appraised value or purchase price. So what happens if your appraisal value comes in lower than the purchase price and now your purchase price is higher than the appraised value? Well, um, you might need to either fill that gap or you could appeal the appraisal if it's really screwing things up. Oh, I skipped ahead there. Now, I want to go back to underwriting a little bit. So once all underwriting requirements are met, you'll get your clear to close. Okay, so this means that you're ready for closing. This normally happens 30 to 45 days after submitting your loan application. Once you're clear to close, closing agent will begin preparing the closing documents. This could take approximately 2 to 3 days, roughly, but ask your loan originator for your timing. During this process, your closing fees are finalized, and many of the title fees will be updated to reflect the final costs for the recording fees, notary fees, and title company fees. The closing date you choose can also impact the final cost, since mortgages are paid in arrears. Now, your closing date will be used to determine the amount of prepaid items included in your closing costs and the amount you pay for your rate lock. And a rate lock on a mortgage loan means that your interest rate won't change between the time it is offered and closing, as long as you close within the specified time frame and there are no changes to your application. So if you don't close within the specified time frame, it may cost you more money to close with that same rate. And once the closing documents are prepared, your loan officer will coordinate with you to schedule your closing, and the closing agent will review the documents one final time before conducting your closing. Remember, though, your loan has not closed yet, so you will want to maintain status quo and not make any big purchases before you close. Okay, so closing day, great news. Closing days here. You're excited. After your final documents are prepared by the title company, your loan originator will schedule your closing. What to expect? So when buying a home, there's lots of paperwork involved which means lots of signatures, and even with all the signatures involved, fortunately, closing won't take all day. The closing process could take anywhere from 1 to a couple hours. I mean, even more, it just depends. So be sure to plan ahead and make arrangements. Up until the day of closing, you've probably had interactions with your real estate agent, your loan officer, possibly the home inspector. At the closing table, however, you can expect your real estate agent to be there, primarily, and then the sellers and probably their real estate agent. And you'll also have your closing agent who will oversee the closing. And you could also have your mortgage loan originator attend if that person can't be there. Ask them to be available by the phone in case any questions come up. Because once everyone arrives, the closing agent will verify all the borrowers on the loan and anyone whose name appears on the property's title. On this at this time, everyone must sign the necessary documents. The closing agent will then walk all the parties through the closing documents and identify where signatures and initials are needed. Some documents will require a notary acknowledgement in addition to the signatures, and the notary is a neutral third party that confirms the authenticity of the signatures. Okay, so just don't forget, you want to bring your government issued photo ID and your form of payment. If you are bringing funds to close, you will need to bring a cashier's check for the funds, not cash. If you are receiving a gift at closing versus being deposited in your bank account prior, be sure to work with the title company to get it transferred to them. And your loan originator will work with you on that to make sure that's done properly. Um, at your closing too, you are going to get copies of the documents you signed, your own records. Those documents include information on your loan servicing, such as your first payment date, amount owed, and where to send your payments. And you'll also get a loan coupon book and payment chart to help you make payments and keep track of your loan. For most loans, the important thing is to make sure that the payments get to the right place and on time. So pay close attention to that first payment date. And if you can, maybe even get on auto pay just to ensure that everything's being paid on time. Definitely don't want any mortgage lates on your credit report just due to something that could have been avoided. Now, you may also get tax forms that need to be taken to the city or county so they know the property has changed hands, and you'll get full inspections from your closing, instructions from your closing agent on what to do with this information if it is given to you. Now, usually you'll also be able to get the keys at closing. However, if you are allowing the seller to live in the house for a certain amount of time after closing, you may not get the keys until that agreed upon date. But I mean, that is in a nutshell the whole process of that a first time home buyer needs to know of. Um, and that concludes my presentation on what to expect when you're a first time home buyer looking to buy a house. Now, I see there's not too many people in here. Um, we got a couple. It looks like Andre Flores and Rebecca Velez. Welcome. Thank you guys for coming. Much appreciated. I hope you learned a thing or two. Um, and if you have any questions, go ahead and fire away. I don't know if Justin, I'm not sure if they have the ability just to, if they have microphone ability to go ahead and just ask any questions or what? Nope, we got a chat. Okay, they can type it here. Guys, if you have any questions, go ahead and type it in the chat box and I'll see it pop up. Or they can use the Q&A. Okay, or you could use the Q&A function as well. Okay. Yeah, just go ahead and drop it in the chat if you have any questions. I'll leave it open here for some time so you guys could think of any questions you might have. Don't everybody jump all at once now. uh you could ask anything. Anything. I'll give it another minute or so, and then we could conclude this here in a minute. Well, I again, I appreciate it to those of you who attended. I appreciate anybody who takes the time to listen to the recording. I hope you learned something. There's something you could take away from this. I wish that there was a couple more people in here so I could answer some questions that people may have. Because I know I kind of briefly just overviewed the whole process. I didn't get, too detailed about certain things just because if that would be the case, I could talk about I could have been here talking for a whole nother hour. But if you do have questions about different loans and products and such, that's a conversation you could have with your loan originator once you're ready to get the process started. I'm sure they'll be happy to make sure you fall within the program that's best suited for you. So that's kind of why I just did a brief overview of the process. Um, Again, your mortgage professional will be ready to answer any questions you have and help you get into the best loan. So again, appreciate everybody who came. Thank you, Justin, for helping me set this up, and I'll be looking forward to the next one. Thank you.